Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Weston Nakamura, who's a former Goldman Sachs and Jefferies trader in Tokyo and currently manager of the Real Vision Exchange. So, Weston, thanks for joining the podcast today.
Thanks, Anthony, for having me. And just to update, so my title is Global Markets Editor at Real Vision. So,
Oh, okay. So, have you gotten the promotion then?
um, sure, let's call it that. It's a kind of a expanded role.
Okay, awesome. Good stuff. So, yeah, I was wondering if you maybe want to give us a little bit of a overview of your background and maybe how you've got into this stage, because from what you were telling me before, it's sort of not the conventional route.
Yeah, so thanks for again having me here, and thanks for asking that, because this is kind of this is a rare opportunity for me to like talk about how I came into finance and how I actually came to Real Vision, or to where I am currently. It's far from a typical sort of avenue, and when it's important for two reasons. One is because people seem to find, I guess, like inspiration from it, which is good if that's the case, or not. But the other more important reason is that it provides background context as to all the views that I put out there all the time, like you so that you know where I'm kind of coming from, where my values are, if you will, and all that. Is not what you would think. Like if you just heard the intro, you would think like I'm a Goldman guy or something like that. Yeah, that might be true from like a sliver of my past, but it's not the full picture at all, and that by itself is not really good context either. So I'm in Tokyo, as you mentioned. I've been here for a few years, but I'm, U.S. born and raised, as you can tell by my accent. And so I just want to first and foremost say that I am not a typical finance person, institutional finance person by any means. As in, I have a horrendous academic record. Okay, right off the bat. So I'm, let's call it a D student. I mean, I've been in the bottom 0 to 10 percentile of my class in terms of like academic, grades and all that for my entire life, from high school, college, all that kind of stuff, right? I basically graduated with a barely passing GPA, grade point average, from my university, which was a degree in nothing related to finance. And I graduate basically right in between when Lehman Brothers and Bear Stearns, or when Bear Stearns and Lehman Brothers fails. So it basically doesn't matter if I tried really hard all my life at school or not, because everybody in my entire grade and the grade below me and all that, and the preceding one, got completely screwed, because we graduate into this time where we're supposed to be getting our entry level foot in the door. We got totally skipped over, because when the economy recovered, they just went to those new grads, and so our specific kind of sub cohort within millennials really got screwed for that. But anyway, so I graduate. I always paid attention to kind of current events and sort of like news and all that, and I knew nothing about I never heard of Bear Stearns or anything like that. When Lehman went down, and the entire world ended, it was a massive, like, kind of wake up call, like slap in the face to me. And it was like a wake up call, but like in two particular sort of instances. Well, number one is that I realized that I actually didn't know anything about anything that actually mattered in society, as in like financial markets. And so I better sit up and pay attention, or rather do a deep dive in, right? Politics, this and that doesn't matter apparently. And so I was totally, misguided my entire life. And then wake up call number two was that I realized that finance is the most powerful institution in the world. Okay, even more so than governments, right? Financial institutions in 2008, they blew up the world, and then governments, they moved heaven and earth to make sure that those very actors were the only ones who will remain employed, as tens of millions of jobs, that have absolutely nothing to do with finance, with subprime mortgages, with green and red blinking tickers, were destroyed. And so the stark reality was, at the time, was that if I want job security in this world, I need to be at a too big to fail institution, right? Because it doesn't matter what if you're mechanic or engineer or lawyer or bartender, whatever, if the people who move digital pieces of paper around the world, if they fuck up, you will be directly impacted to the downside. To the downside only, right? Because remember, privatized gains, socialized losses, right? So need to get into a too big to fail bank. Easier said than done, given the climate, the environment, and given my zero track record. Then so fast forward to 2013, Abenomics is rolled out in Japan, and then so I see this as like, all right, so if there's ever going to be a one long shot chance to get my foot in the door into institutional finance, then this might be it. Tiny as a chance it may be, because I figure there's going to be this huge like waves of foreign capital that are going to rush into Japan, and so even though I neither spoke Japanese at that point nor understood anything about finance and markets, like if I could be in sales and position myself to like serve as an English speaking liaison to investors, foreign investors who want exposure to some financial product in Japan, whatever it is, then I could be sort of the person on the ground, boots on the ground, to assist doing that. So what I did was, in the span of a few weeks, I just basically uprooted my entire life in New York. I said goodbye to my friends, my family, my everything. I got on a one-way flight from New York to Tokyo with just one suitcase. I had no job offer. I had no contacts. I had no credentials. I had no home. I had no place to live. No ability to speak the language. Like, I had nothing. I basically was kind of hopping around night to night from like one capsule hotel to another. I was living off like 7-Eleven dinners, but I was basically trying to, in the process, kick down the door of every financial institution that had any sort of like, presence in Tokyo. Since basically everyone. Most obviously did not even respond to me. Goldman did, and they were basically like, well, first of all, they were like, this is the most insane like thing I've ever seen. This guy, right? So I went in for an interview. They kind of grilled me on markets and stuff like that. And then at the end, they said, first of all, Weston, you're by far the strangest candidate we've ever interviewed. And I was like, yeah, damn right I am. But they said, look, all right, look, you're a smart guy. You kind of are a natural salesperson, all that. But look, we do have like this whole army of like UPenn and Harvard Business School and Oxford grads out there, right? Why should we give you the job? We offer 2% to like of applicants to the jobs, right? And I said, that's precisely why you're going to give me the job, right? It's because I do not have a Harvard or Oxford University or Tokyo University degree, right? So if you're in your 20s with a Harvard MBA and new grad, something like that, you're thinking to yourself, I can do anything I want. And it's true, you can, right? The mentality is like, so let me try out Goldman. If I don't like it, I could always move to Morgan Stanley or a hedge fund or to McKinsey or to whatever. And all that's true. But if you give me the role, I have no put option. I have no insurance policy. I have no MBA or anything like that. So it means that my paths are either succeed or be homeless. So therefore, like, those other people, they don't know what it's like to be truly, literally hungry, to be motivated, to be driven at that level. And ironically, they're not helped by their MBAs. They're being hindered by them. So what I offer you is my horrendous track record, my non-existing and horrendous, like, grade point average and all of that, and which equates to sort of motivation. So that's how I got my foot in the door of, this is 21 interviews later, I found myself at the listed derivatives trading desk, the futures options trading desk at Goldman Tokyo. So they literally hired like basically a homeless person off the streets. And so that's kind of the context of how I got in. And so I just want people to know that, because when they think of me as some like Goldman person or something like that, yeah, I guess that might be the case, but that's certainly not. I'm far from a typical Goldman person, let alone any sort of institutional finance person at all. And so once again, the reason I share that is because some people find that to be inspiring. And I'm glad that if it is, because what it says is like, there are society's rules of the road, like you must do XYZ to get into this sort of firm, no, you don't. Okay, I'm living proof of that. And the second thing is that because I have this very weird way into finance, I think that's why I have a very kind of non-institutionalized view. of how I approach markets and all that, and kind of differentiated ways of thinking. And so that's to my benefit also. It's not just one track mind, sort of academically rooted, going through the internship system, then the whole process of moving up the ladder and the ranks of within an investment bank and all that. None of that applies to me, so I'm kind of separated from that institutionalization. Thanks for letting me share that part.
Yeah, no, it's a fascinating story. And I guess what would have happened if you didn't get the Goldman job? Just go somewhere else.
Well, my roles, look, when I did this, I was like, my friends would say, like, that, like, you're not gonna get like into go, they'll just walk in, right? They weren't saying like it's impossible, but I was like, look, I'm very much aware of what this is. So what I said was, okay, I will most likely be working at McDonald's. And I'm going to give myself like minimum like a year, at least a year and a half of whatever, of just relentlessly just hammering the door of anyone and everyone, again and again and again. And I'm not just going to kind of say like, okay, well, that's everything. Like I purposely did it a one-way ticket, so it's like kind of undoable, and put myself into a position of, because like the way I figured was, I'm not gonna get into Goldman or whatever, but like let's say like I do happen, or let's say I don't get into institutional finance as per the probabilities, and the worst case scenario is that I uprooted myself out of my sort of comfort zone and I threw myself across the world into somewhere else, and I kind of rebuilt myself from scratch, and I learned like how to survive from starting from nothing. If that is like the takeaway, if that's like the lesson that I learned, that is a lifelong lesson that is far worth it still. So where it would go from there, I don't know, because I could say like, okay, well, that didn't work out, but uprooting my life isn't so daunting after all. What's London like? What's India like? What's whatever like? And then see where it goes from there. But at least get out of my bubble of New York and get out of my comfort zone and kick off some sort of chain reaction of whatever my life may be. So I didn't really know what would come. I was just going to go with the flow, and I still am, for that matter.
Yeah, it's a great way to live. So you mentioned there before that you sort of have like a different way of looking, I guess, at markets in general. So how would you define that unique method?
Um, I would define it as, first of all, different is a relative concept, right? So I would define it as what I'm not doing. So, like if you're analyzing stocks or something like that, like I wouldn't look at a DCF model. I would be so I know what they are. I know I familiarize with myself, or like deep dive in, but I don't adopt them. It's like just because you learn something doesn't mean that you have to apply it. I learn it because other people are learning it or know it and are applying it, and therefore, I care because I care, type of thing, right? Like people look at certain indicators of this and that, like a specific jobs number or whatever. I don't care about an earnings call or a jobs number unless the market participants who have the capital to move green and red blinking tickers care. Then I care. So I care about what other people care about. Um, the way that I approach things, just kind of out of the box, is that I'm very also skeptical of when everybody is kind of in unison saying this must happen or this has to happen. The kind of pay attention to language, and like the musts, or they can never happens and all that kind of stuff. That's when I kind of perk up and look for like an information arb. And then I just approach everything as, I guess the difference is that the reason I would outperform, especially like the institutional side, is that I start off every single day with the mentality of, I don't know anything. Nobody does, right? Nobody knows how the market's going to trade at the end of the day. Even if you're insider trading, you might be trading the wrong direction still. But I don't know anything is how I start my day. However, let's find out. Let's figure out what's going to happen. People who think that they know, and say things like the market will come to me, The market doesn't care about your spreadsheet model. It's going to do what it's going to do. And those are the people who see themselves holding positions down 50%, 60%, 70% because the market will come to me, like the MBA person, whatever. Those people have to unlearn everything that they know and start off at, I don't know what's going to happen. They have to do all that just to get to where my starting point is. So my edge is that acknowledge you don't know anything, but also acknowledge that nobody else does either, and then try to figure out and try to exploit the people that think that they know what's going to happen and are like so definitely sure. Alpha to me is exploiting like an understanding and kind of almost an ego arb, if you will.
Yeah, that's really interesting. I think that's Renaissance technology is. I think that's what you've probably heard of the hedge fund. They actually take advantage a lot of the time of these retail traders and these people who have, follow these certain trends, but you're actually focusing on what are the big institutions doing that who can move the markets, and then from there
Well,
yeah, would you say that?
no, yeah, no, it's not. It's not just institutions. It's people. I look for what moves green and red blinking tickers in what direction at what sort of velocity. Um, and the source of the capital itself, it could be institutional, but it could also be retail. So I've had this long held belief. The reason I'm no longer in institutional finance. I left institutional finance. I'm at Real Vision, which is more of obviously a individual investor facing platform, is because long before GME and all that, I had this broader view of being short institutional and long the individual, collective individual investors. And I actually have on the Real Vision Exchange, I have a video clip from November of 2020, saying that the institution, the retail or the individual, investor community can act as, when grouped together, they can act as a giant asset manager pooled together with their capital, that they discuss things on trading forums. They have systems like copy trading and all that kind of stuff. And they could act as a giant asset manager who has market moving abilities. And then a few months later, we have GME, and this is like exactly what I was basically talking about. So I look for whatever the flows of capital are, whether it is on the institutional side, whether there's a market maker on a trading desk that is, trying to hedge their delta exposure to options markets, or whether it is quarterly rebalance of some index, or whether it's the GPIF, the largest pension fund in the world, the Japanese pension fund, and their treasury buying and selling activity, or Japanese institutions in general that are buying and selling of treasuries. And so whatever is like the source of the capital, I don't really look at the asset. I kind of turn around and I look at the capital behind it, and I study the behavior of that, is how I kind of approach things.
Yeah, so you study the capital, and I guess then you understand what are their limitations, or what are their
What are
motives
goals?
to
What are their
stay.
yeah? What are their goals? What are they trying to do? What are they forced to do? How much more do they have? What risk? How are they cross correlated? What other exposure do they have to what? And just the behavior of the capital itself, right? Because markets by and large move on flows of capital, not on fundamentals, not on what even central banks, are trying to do. Let's just look at the repo market in September of 2019, right? Like, you can set the Fed funds rate as target as whatever you want to, but it doesn't always work out that way. Capital is going to do what it's going to do, and you have to study that, not look at the asset itself. And study the behavior of that. If there's going to be a short squeeze, if there's going to be a whatever, if the UK gilt market's about to blow up, what's that going to mean for the British pound, and therefore everything else as well that's kind of interlocked with that. So that's how I kind of approach things. What I generally say is that everybody more or less in public markets, we all get the same markets. We all get the same, SPX. We all get the same Euro USD cross, whatever it is, and therefore the same markets, right? So why is it that some people make billions and others lose everything and then some in the same markets? Well, it's not the markets themselves. It's how people are behaving differently within those markets, right? So you're not really ever trading markets. You're trading against or with yourself. in relation relative to others as well. So that's how my approach is.
Yeah, it's a fascinating way to look at it. So, can you maybe give an example of, you mentioned a few there to do with pension funds, I guess GME as well, an example of a time where you've seen this and you've made a trade based on it?
I basically only make trades based on so like I have many. Okay, here's one. So um, I'll give you one from if we're gonna talk about Bank of Japan and dollar yen and all that kind of thing, and the Ministry of Finance. So I had a view going into September BOJ monetary policy meeting. This is the day, by the way, that the Ministry of Finance first blasted dollar yen down with their intervention. But before that, what you had was U.S. 10-year U.S. Treasury yields and dollar yen moved tick for tick in tandem together. And then there was like a lot of jawboning happening from the Ministry of Finance, but then the Bank of Japan kind of stepped in and did jawboning of FX, which is a very kind of rare thing to do because it's not in their remit to look at FX. But after that, that yield spread kind of just widened out, and therefore the 10-year U.S. Treasury yield and dollar yen kind of split off. And so dollar yen should have been 146 plus at that time. So going into that Bank of Japan meeting, I was thinking, okay, well, here's Governor Kuroda. He's going to be asked about comments on the FX, on the exchange rate and all that. He's not going to say anything about that because it's not in his remit. He's going to say this is not in our remit, and so therefore he's not going to say anything that's yen supportive. So short the living daylights out of the yen is what I tweeted at that time. Then yen actually did fall precipitously over that time, and I traded with futures directionally, and I was basically able to kind of exploit the people who thought that he would be kind of yen supportive, or at least close up that gap that had existed. The second lesson there is that once that catalyst was realized towards the end, about the last back maybe like 10 minutes or so of his press conference, I closed my position and I had a nice profit. 20 minutes after that, the Ministry of Finance came in and they blasted dollar yen down, or they short squeezed the hell out of yen futures, and I would have gotten destroyed if I didn't close my position, even though I was right up until then. I would have lost way more than I had made that day. And so the lesson there is, once again, you never know what's going to happen. So once you get a catalyst realized, like, take your position off. I guess to answer that second part was not really answering your original question, but yeah, like that. Or another example would be like the very easy ones, like the Ukraine Russia war. So when that first happened, I don't know if you remember, but days before that happened, President Joe Biden was making very definitive statements saying Russia is about to invade Ukraine. He repeated this, his cabinet repeated this, and Blinken repeated this, and markets didn't move. And then, like 3 days later, Russia invades Ukraine, and markets like took a huge leg down, a risk-off leg. And I had my reasons for, I had a thesis for like Russia's going to make some sort of market moving like risk off event immediately following the Beijing Olympics. I had that view for a while, like I was talking about on Real Vision, it's all out there. But when the President of the United States tells me that there's going to be a major risk off event imminently happening, I'm going to position for that. But I also saw that because markets didn't move, I recognize that there are so many people, and by markets I mean like kind of single stock equities in US. So like I went like long calls on like Lockheed Martin, stuff like that. I recognize that there's so many like people like within the adult population of in the United States at least, on both sides of the aisle, who think that Joe Biden is like a brain dead person who's propped up on like a stick, right? And so anything that he says must be right or wrong or whatever. And I recognize that there was like this sort of weird political bias or something, but there was this arb to take advantage of, that people are not taking this guy seriously because when he says there's going to be a risk-off move coming and the markets don't move, there shows that there's a potential opportunity. And so that's kind of how I took advantage of that capital behavior.
Yeah, it's as you said before, it's not about the actual news and what's happening. It's about how people react, and if you don't see that reaction, that's when you see the opportunities to potentially take a position.
How people react, how capital reacts, because it's not always people; it could be systematic too. So, yeah.
Yeah, exactly. No, it's really interesting. And yeah, you mentioned the BOJ there, and I think you're quite well known for your videos about the BOJ, specifically on Real Vision, for good or for worse. But yeah, I was wondering if you maybe could give an explanation, maybe about the current policies that the Bank of Japan are implementing, and maybe why they're not what everyone else is doing.
Sure. So when you say I'm known for it, I don't know if I'm known because I'm a clown or if I'm known for the information itself. I don't know what I'd be more proud of, because I take pride in being a professional clown. But look, again, this is the reason I said that whole background at first is because look, I'm not a Bank of Japan expert. I get just before this call, like I had institutional, large prominent sort of people within institutional finance asking me my view about BOJ and the yen and the JGB markets, and so it's insane to me that they're asking a D student this. But again, I was able to kind of at the beginning of this year be early and say the Bank of Japan is not a sleepy central bank that you must pay attention to. It will make headlines and waves. It's the most consequential of the major central banks this year because of the fact that people are not paying attention, let alone the fact that they are going to be on this easing path while everybody else is hiking rates. And again, the it's not an outside view. It's just because I'm starting off from a clean slate, and that's how I analyze things. And as I said to you too, BOJ is important, and I have like kind of knowledge about it, but it has nothing to do with me being in Japan. It's totally coincidental. I'm only looking for what moves green and red blinking tickers. That is, to me, was something that was going to be moving green and red blinking tickers, and it doesn't matter if I was in South Africa or trading out of Brazil or New York or wherever. I would be looking at the Bank of Japan. Just so happens that I'm here. It's totally coincidental. So I have no edge here because of geographic location. Just want people to know that. So with that said, so yeah, BOJ is currently in a stance where they're almost at this moment they're kind of being proven to be correct for not having moved their policy against everybody else who has been the entire world has been removing accommodative policy. They've been hiking rates. BOJ has been just really, really just holding the line on their aggressive easing, and all the while they're doing this because they're saying the inflation that we're seeing in Japan is, first of all, it's like headline CPI is now at like just over 3% in Japan versus like the almost near double digits of other DM. So is it cost push driven or not? And if Kuroda is correctly saying that this is mostly driven by rising cost of energy, imports, and things like that, but at the core level you're not seeing like a massive demand driven inflation for TVs and electronics and stuff like that. And so he's saying that, and you don't see wage inflation. So unless you start seeing those things in a sustained manner, we have to keep doing this because we've been basically easing for 8 years aggressively on monetary policy experimentation to a level where you have the Bank of Japan's balance sheet at 120% of GDP, far more aggressive than any other major central bank, owning half the JGB market. You're not going to just like pivot on that after nearly a decade of doing that on a single CPI print that is at the headline level. So it seems like if inflation is topping, at least in the US, and if we're kind of entering a potential recession, and then you might see like inflation, like the rate of change in the US or ex Japan start to level off and potentially come down, regardless of what the policy is. If the market expectation is that the FOMC or the ECB or whatever might like pause, then Kuroda was correct the whole time in saying like, yeah, it didn't apply to Japan, so it is sort of transitory in nature, but it's external. It's not something that's shifting fundamentally in Japan, and therefore there doesn't warrant a change in policy. And so Kuroda might be proven correct. So I think that as it stands right now, the Bank of Japan is going to continue to just maintain as it is. The important part is Kuroda is done in April of 2023. And so it's not that much time between now and then. There's only a few Bank of Japan meetings left. And his successor, whoever that may be, and it almost doesn't really matter who it is, but what's going to happen between now and then. Kuroda, Bank of Japan Governor Kuroda, who's the longest serving major central banker right now, that's currently active, as well as the longest central banker in BOJ history, or the longest tenure in history in BOJ history. When his leaving in and of itself is massively significant, and there's going to be a ton of volatility and uncertainty and sort of headline driven things that are going to happen in between now and then. So I can't really tell you what's going to happen, but I would think that whoever the new person is, even if like the economy globally and in Japan has an inflation top and maybe even a pullback, such that yields, DM yields everywhere start to pull back down. JGB 10-year yields move back down towards like zero, where they were just a year ago. And there's no need for like daily fixed rate operations to keep buying JGBs at the 10-year tenor to cap at 25 basis points and all that. Even if that happens, I think that the next person is going to have to do some sort of tweak, a tiny one or a major overhaul or whatever it is. What they cannot do is maintain Kuroda's policies word for word, because if they do that, then they're stuck with Kuroda's policies forever, and it's going to have a very horrendously volatile time to try to get out of that. So just for the sake of, hey, new person, thank you, Kuroda, for achieving the 2% plus target of getting Japan out of deflation and into inflation. Now we're handing off the baton. And then this next person needs to be sort of a wild card, and like, you don't know what we're going to do. Just know that like Japan, the Bank of Japan, will do whatever we please, whenever we please. Don't fuck with us. Don't you dare short the JGB market. Otherwise, you will be made a widow, or your spouse will be made a widow. And I think that they have to buy themselves flexibility, policy flexibility. Currently, the language is that we are targeting around 0% for the 10-year JGB band. If they want to hike rates, they'll say like, we're going to target around 25 basis points, which is where it currently is, but that would give them a little bit more flexibility. But I would say that they would have to widen out the kind of the band to the upside and the downside, because that way, again, it gives them more flexibility, gives them a wider range to work with. In the meantime, what to do with the yen? If U.S. yields keep surging upwards, which they're not currently at the moment, but if they do, and the yield spread between Japan and the U.S. widens, and dollar yen starts to go towards like 160 handle or whatever, then Ministry of Finance is going to keep stepping in to blast USD JPY downwards. And so therefore, it's been my kind of view over the last, since that almost horrendous accident I had in shorting JPY futures in September. But the new widowmaker trade might be to short the yen at the kind of USD JPY like highs, because the Ministry of Finance could come in and just blast dollar yen down again and again. And again, this goes back to the reason it's a widowmaker trade is the same reason as JGBs are shorting JGBs is a widowmaker trade, because fundamentally in the UPenn textbooks and the University of Chicago, Booth School textbooks, it makes fundamental sense to short the JGB market, right? Like, the Japan's the most indebted country in the world. You are not going to get your principal paid back from Japan if on their debt. There's no way to service it, let alone to pay you back on your principal. Population shrinking, it's getting more, the debt burden is increasing. So it makes fundamental sense. However, Japan has a way of defying economic gravity. And so that's why it's the widowmaker trade, because if you follow fundamentals and you shorted JGBs, you would have gotten carried out. I think that currently the economic textbook says you can't support both the rates market and the currency market at the same time. It's one or the other. It's one at the expense of the other. The Bank of Japan has been supporting the JGB market at the expense of the yen, hence the yen becoming the worst currency year to date, getting destroyed. That's why that's happening. Those are the fundamentals of how it works. Yes. However, do not underestimate Japan's ability to defy economic gravity. And so they could very well support the JGB market while supporting JPY at the same time for longer than we think. And so if you want to short the yen and mess with the Ministry of Finance towards new highs, like USD JPY new highs, I think that that's a very, very risky thing. And again, throw away your textbook, look at reality. Bank of Japan and the Ministry of Finance in Japan is kind of very unique in their ability to defy gravity.
Yeah, that's a great explanation. So you mentioned April is when there's a potential that there will be a new sort of chairman of the central bank in Japan. So you don't think there'll be a massive pivot? You think it'll more just be maybe a small potential change that they make?
Um, I think that I think that there is no such thing as a small change. In terms of the language might be small, the market reaction that would come of that, there isn't really a gray area between like huge like cross asset volatility explosion and nothingness like maintained, because the like I said, there's not going to be a sweeping overhaul, but even if they widen the band on JGBs, just doing that in itself would be hugely consequential to markets, because it would have direct implications on the U.S. Treasury market, which is the risk-free rate, and the U.S. Treasury market volatility at a time where there's a lot of illiquidity, and that volatility could therefore be exacerbated. And it could be like kind of a trigger moment for a potential what happened in the UK gilt market to happen in the US Treasury market, with a slight tweak of a language of letters on like ink and paper printed out of the BOJ saying, have fixed rate operations for the Bank of Japan to target 10-year JGB yield at around 25 basis points instead of around zero. That shift in itself could potentially be the trigger to send the U.S. Treasury market in a massive, tailspin, in which the Fed will have to do what the Bank of England did and suddenly reverse and start buying directly the long end of the U.S. Treasury curve, in order to keep 30-year U.S. Treasury yields from jumping 100 basis points in a week or something.
Yeah, it's crazy to think, and that would be the capital from, I guess, the Japanese pension funds going like flowing back into Japan. Would you say, or where would that come from? Do you think?
So that would happen as a result of that's sort of a hybrid between the fundamentals versus like the capital flow. I like your take on that. Yeah, that's how it would happen, but it would actually be more kind of mechanical and technical, because if it's illiquidity, it's when Kwasi Kwarteng from the former administration in the UK released the mini budget and all that. Yeah, that might be the catalyst for it, but that wasn't like the UK gilt market. The longer the UK gilt market selling off wasn't really fundamentally based. Like, people doing the math saying, "Oh my God, the UK can't afford this. So this is like we must sell UK gilts at the long end." No, that was like blasting through 4% on the 30-year UK gilt plus illiquidity, and it was much more technical driven. And then that selling begets selling, and sort of again systematic flows and pension funds unwinding at fire sales pace, and all that. That wasn't really fundamentally connected. It was just very disjointed, markets kind of like, I guess, behaving in a erratic fashion, and that is what I'm talking about more so. Like, so it's not like Japanese pension funds or something like who will reallocate out of the US and back to Japan now that there's a yield in Japan or something like that they could avoid FX volatility risk and all that kind of stuff. There might be that, but it'll also just be the fact that, look, put simply, year to date, if you think about the safe haven for the rates market, the DM rates market, which is the safe haven asset for financial markets writ large, has been the JGB market, right? If you own US Treasuries year to date, you're getting destroyed. Like, you can't buy any. What are you gonna buy? Italian BTPs? UK gilts? You can't own any of this stuff except for JGBs. JGBs have been the safe haven. They've been flat, right? So, and the reason is because there's an explicit floor. There's a central bank put. We will buy an unlimited amount of JGBs, 10-year JGBs at 25 basis points, full stop, period. Okay, so if the assumption is like, okay, so that is like guaranteed, And once if that floor is removed, and expectations and risk models are based upon this is something that's guaranteed, and that guarantees gets taken away, then cross asset mayhem, erupts. And so that's basically what would cause that, not so much the pension funds themselves.
Yeah, no, it's a fascinating way to look at it. And as you said there, with in the UK, they're basically doing QT, quantitative tightening. One of the major buyers has come out of the bond market, so it makes it a lot more, you could say, illiquid, a lot more potential for these massive moves with less capital.
What? Who's that? The Bank of England, you mean?
Yeah, in the Bank of England, but you could say the US as well, where the Fed aren't buying bonds anymore, so there's gonna be that less capital. Is going to be not easy to move the market, but these events could be a catalyst for that.
And they could just as easily as they were able to step out. That's giving a lot of a lot of leeway too.
Yeah.
Just as easily as it wasn't easy, nor did they step out. But just as easily as they were to step out, they can very easily just step back in. It's gonna just have to be, and look, they'll be right to do it too, because it's not based on fun. They're not doing it for fundamental reasons. They're not. It's not gonna be a QE in that sense to stimulate. It's a QE to stabilize. But that messaging is gonna be. I mean, if they can deliver that messaging flawlessly, so that markets understand, like, okay, we understand what's going on. We understand this is truly a non-QE QE and all that kind of thing. That would be impressive. I got to tip my hat to Governor Bailey for actually being able to get in and out and do a temporary 2-week reversal on QE and sort of what I call single serving yield curve control. Good for him for them to be able to pull that off. And let's see if they can get back on track with their original. But if they did that, that would be certainly impressive. But I don't think that the Fed could do that because it's over scrutinized, it's over analyzed, and therein lies opportunities too. When people like who are betting on like this is the end of the United States and blah blah blah, like those sort of things, when those sort of flows are reflected in markets, like you could take the other side of that too.
Yeah, it's interesting. So obviously you're focusing on the BOJ potential, what's happening there. Is there anything else that you're sort of keeping a close eye on that you think could happen in the future?
Yeah, so look, again, the reason I'm looking at the BOJ is nothing to do with my geographic location. I'm keeping very close eyes on it because that has been that will continue to be the major central bank of uncertainty and consequence, along with the PBOC in China and all that. While I'm watching, yeah, China, Japan, I watch the US obviously, but the reason I don't pay attention, relatively speaking, is because everybody else is, and so everything is priced into markets already. What, you want me to give you like a view on the Fed, like the FOMC and like inflation? I mean, good God, everybody's doing that, and you don't need my view, nor would you want that. But yeah, I would suggest strongly looking at Asia, especially Japan and China, and if you're basically like only allocated to your whatever country you're in, but let's say you're just US based and you're just have like a US stock based portfolio, I think that we're about to enter a period of like fragmentation of markets. So not everything's going to be just risk on and risk off anymore. There's going to be within, not just within indices, but within sectors, company A will outperform company B by 80%, in the course of 12 months next year. There's going to be different FX pairs that are going to move differently. Like, not everything's going to be against the dollar at the same rate, as we saw with the British pound and the yen, two major currencies, which were just a month and a half ago competing for the spot of worst performing currency year to date. And they were doing so for totally sort of idiosyncratic reasons, for completely different reasons, right? And so I think that the days of correlation of one are over, that we've been used to for the last 10 years of central banks doing the same thing. And then obviously COVID really, boosting correlation of one to everything, both going into and coming out of COVID. But now that central banks and sort of like the policy accommodation papering over of everything is being lifted, it's exposing and being reflected in markets all of the different idiosyncrasies within regions, among regions, within companies, balance sheets, and all that kind of thing. So now truly is a time going forward. 2023 is going to be a time for asset selection. That you can see that as an opportunity. You can see that as a risk. You can see it as an opportunity. As like, you could also see that as crap, I have single like country exposure. I need to diversify. I need to buy. I need to own Australian equities or whatever it may be. I'm looking at just again the cross asset picture, broader, writ large, and how those divergencies will play out and reflect their fundamentals and what the kind of rhetoric is around the world. IMF and all that are still talking about like, yes, we're in a globally synchronized monetary policy. No, you're not. So we'll see how long that lasts. That and crypto as well. Obviously, there's a different kind of asset class in itself. But that's also what I'm looking at.
Yeah, and do you have any thoughts on the current sort of, I guess, FTX crisis that we've been experiencing? I think you were mentioning before about how some of Fintwit and what you've seen there, you haven't agreed with.
Oh, I thought you were gonna say my FTX Japan account, which is no more.
Yeah, I saw you. I think you linked something that what they were about to open an office in Tokyo. So that's obviously
that's the top. Yeah,
yeah. That's an indicator. If anyone opens an office in Tokyo,
when you brag about your new office, look at the balance sheet of that company. Yeah. So regarding Fintwit, what I was saying was, and by the way, the FTX account thing, by the way, it's because I had there was a exchange called Liquid in Japan that I used to use to take like directional downside positions on BTC. You could go like 4x levered on that. That was bought out by FTX. haven't used that. I didn't even know I had an FTX Japan account until I got an email saying that I can't withdraw things. So I was like, oh, okay. Yeah, with regarding to like Fintwit, this is not really anything, I guess, particularly unique as a situation, but for me, I don't know why it got to me this time, but it's really been kind of, I've been very, I don't know how to put this. I'll just say, for lack of a better term, as well as non-comprehensively, disgusted at a lot of the things that are like espoused out on Fintwit. So, namely, the blame game. There is, as far as I'm concerned, one individual or a handful of individuals who should be blamed for FTX, and that would be the people at FTX, namely Sam Bankman-Fried. But right now, there is like this massive, like, kind of wave of like, you are responsible for this and you have accountability for this and this and this and this. Look, Larry David, for example, right, who's getting sued right now apparently for his commercial. Larry David does not know anything about crypto. He didn't look at the balance sheet and see like FTT tokens made up the bulk of the balance sheet of the assets, and therefore let's like this Alameda's co-relationship is a scam, and let me add to my $800 million net worth by doing this commercial. Like, he doesn't know any of this. He is not at all like responsible for the fraud that was happening there, right? And so everybody was sold on this. So to point fingers at, and I know it sounds like because like Real Vision gets blamed or whatever too, like everybody gets blamed. Everyone's getting blamed, right? I'm not defending Real Vision. I am calling out to specific people or like a specific kind of behavior. If you have lost money, as I have, or gotten money stolen from that from you, that is a terrible thing. That is a shame. However, bad actors in markets and all that kind of thing happen. You could, just as much as somebody could break into your house and steal your TV, things will happen. You have to be aware of those things, right? In terms of someone that you should if you're just somebody who's constantly out there just like throwing names under the bus and saying like, this person is responsible, this person is responsible, this person is the reason for this fraud to perpetuate and all that. No, everyone was duped and all that. And secondly, and more importantly, how about, if you're going to do that, fine, but also the other side of take personal responsibility for your investment choices. Nobody put a gun to anyone's head to say, buy this. unless you're a big Bitcoin maximalist, in which you're putting a gun to people's head and saying buy only Bitcoin. But that aside, um, like there is such the ratio of people who are saying you are to blame, this person's like promoter of scams and blah blah blah, and I need to take personal responsibility for my own actions, even if they were I'm victimized by fraud and all that. That ratio is so imbalanced that that's really what disgusts me. I think like my disclaimer for trading and all that is, if people see my videos, is literally this: if you listen to me, you will lose all your money. If you use me as a reverse indicator, you will lose all your money still somehow. The reason is because I'm a very stupid person and these are very stupid thoughts. So I'm going to tell you what I do, and if you decide to apply any of it, please do so if you hate money. That's as clear as I can get, and that's what I say all the time. But I'm not joking about when I say that. Like, it sounds funny, but the reason I say that is because, look, if I'm talking to, I don't know who's going to be watching these videos. I don't know your individual risk parameters and this and that, and like, what kind of trader you are, if you're long term, short term, what time horizon. And even if I did, there's somebody else watching who's the exact opposite. So there's no way for any financial commentator to give financial advice fundamentally to begin with, because everybody is so different. So you have to apply it to yourself. Like what works for somebody, it's not going to work for somebody else. That's the nature of markets. So you have to the only one who understands your risk level or whatever is yourself. There's no way that somebody else on our side of the screen can do that for you. And if you don't even know that yourself, you need to take a cold hard look in the mirror and understand that like you are the person who is like making financial decisions, whether they're in frauds or otherwise. If you're victimized by it, then so therefore acknowledge that others who promoted them possibly were victimized alongside them and lied to as well, just in the same boat. And if you're not going to do that, just take a good intrinsic look at yourself and say, like, where can I learn from this? What can I do? The trading losses are not losses. If there is a takeaway from it, then it's just tuition. If there's no takeaway, then you're only left with the loss, and therefore it is not tuition. It is a pure, loss. Have a positive takeaway, learn something from it, stop blaming others, don't add to this like attacking of each other. We are not better off by this. Nobody is going to be made whole from doing any of that, and nobody is benefiting, or for that matter, nobody is really getting punished as you wish as a result of those sort of efforts. So that's kind of something that I want to get off my chest. I don't know what your thoughts are too, because I know because you could very well be, if I turn out to be a Bank Japan insider this whole time or something like that, you had me on, Anthony. You participated in this fraud of the yen market or whatever, and you could be at risk of that too, right? But you're obviously doing this to this wonderful podcast to help people and to educate people, right? And that's your intention. And if you have like some scumbag like myself on, then you will be held like to feet to the fire and all that. So what are your thoughts on that?
Yeah, I just think that I'm surprised people aren't more cynical, and that might just be my own personal opinion. I'm quite cynical when it comes to, as you mentioned there, putting money into assets or even listening to things. So I'm always that person I'm like the perma bear almost. I'm always like that negative person thinking like, okay, is this really the case? So I feel like, I might not, as you mentioned there, like I am cynical myself. So then I don't really think that some people are just very trusting and they just will listen to someone and say, oh, yeah, I have to do that. So I feel like sometimes, I'll have you on, then I might have someone else on next week and they'll say the exact opposite. And I really enjoy that. And I think sometimes it's just about listening, being very cynical about what people are saying. And then you hear something like, oh, okay, that sounds interesting. Let me do more research. So I feel like that's where the space really needs to go, to the point where, sure, someone can give their opinion, but it doesn't mean that that's what you have to do, is actually having your own beliefs and, doing your own work about it.
Yeah, like exactly. Like there's, like I said, there's fundamentally no way for somebody to give trading advice. If I say short dollar yen, or go long dollar yen from here to 146 into the end of the year, and let's say dollar yen drops to, I don't know, 70, and you're totally blown up. Okay, tomorrow, right? Um, am I to blame? And you had that trade on, right? Am I to blame for that? I blame myself for my portfolio's uh, P&L, gains and losses. And I don't blame markets for that, and I don't blame the shenanigans happening at Bank of Japan and the Ministry of Finance. And I don't blame anybody else who I got an opinion from either about that. If I said like, "Hey, trader at this institution that I know, what do you think of this?" And they said like, "Yeah, it makes sense to put that trade on." I'm not gonna go back up to him and say like, or her and say, "You said that was a good, like, you agreed that with me that was a good idea. You need to pay me back for the principle of like what I've lost." Like that would be ridiculous, right? So it's impossible for us to be able to address everybody's like individual financial portfolios and needs and risk tolerances and objectives and all that. And so you have to just take away what you will, apply what you will, but either way, it's in your hands. It's not in anyone else's. Even if you get your funds stolen away from you, literally, it's not in your hands. But that is something that if you didn't do the due diligence on SBF and lost money, well, then that goes for Larry David as well. All the same, right? So there just needs to be more public I would say public accountability for like self accountability, or public self responsibility taking, I guess. Which nobody will say that, so that needs to net out as less of the blaming, one side blaming of the others, because otherwise the Anthonys of the world are just gonna stop doing this like sort of amazing service that people are getting huge value out of, right? So
Yeah, I think I might be like, and it might be from your perspective as well, because you backed yourself when you went to Japan. So I'm not sure about you, but I went a different path, and lots of people told me no. So I don't really, no offense to all the listeners, because I love you all, but I'm not fussed about if I get those negative comments or anything, because I know, people enjoy what we're doing, and probably similar to yourself, you're not fussed to get those negative comments because you're more self accountable to yourself.
yeah, thank you for being the voice of reason amongst the two of us. Before I get to like kind of ranting about this, I do want to say, however, I completely appreciate, and I'm sure you do too, everybody else who isn't like that, who actually does do I'm not saying I'm making a broad, across the board statement to everybody. There are plenty of people. There are more people actually who are supportive of people like you and I for doing what we're doing. It's very difficult to do what we do. I mean, you're more on the interviewing side. I'm more on the kind of look analytical markets involved side. And so I get asked the questions versus vice versa, and so on and so forth. That doesn't mean that you obviously you still have to do your own sort of research. I look at you as kind of like a market maker of information, and I'm kind of like a prop trader of information. But like it's very difficult to do the things that we do, let alone to put it out there for free to consume. Not because there's no like direct like immediate revenue from that or something like that. It's because we put ourselves at risk of those very sort of voices out there knowingly. And so just shut the fuck up if you're one of those people, because you're ruining it for everybody else who are getting value out of people like Anthony.
Yeah, come at us. Put all your negative comments down below.
Yeah, yeah.
No,
I'm also desensitized too, so bring him on. But like, I mean, if you do,
yeah,
just also you better throw in a. However, I do take personal responsibility for my own portfolio actions as well. Disclaimer, and then say whatever you want to.
yeah, exactly. Makes sense. So, Weston, thank you so much for your time. I really appreciate it. I guess my last question is, what is one message you want people to take away from our conversation? Because we touched on so much stuff.
Yeah. If you're new to finance, the perceived hurdle might be very daunting. But look, look at like my background. Look at me. Like I said, people are, if you think that I'm a credible voice on the Bank of Japan, when I was Anthony's age current, I didn't know what a bond yield was. So, and that wasn't that long ago. So the hurdle to get up to speed is not as daunting as you think, because it's not that there is like this all-knowing benchmark. It is that you just have to get up to the same level of nobody knows anything, right? You have to know the like kind of basic fundamentals of how things work, but after that, market views part of it, nobody knows anything. So it's actually relatively not that steep of a hill. And then if you are an experienced person, don't think that you know everything, and and humble yourself and get back down to I don't know anything. And that middle area is where you need to be, for both sides, I think. So constantly keep learning. It's never like I've learned finance. There's that moment is never gonna happen. You every single day you don't know what's gonna happen, and that's normal and it's great. And if you can acknowledge that, then ironically you are more knowledgeable relative to. And since science is a relative game, you can find alpha in that. So take comfort in the fact that you don't know anything, you won't know anything, and neither does anyone else.
Yeah, it's a great message. And it all compounds at the end of the day. Like, it takes years to learn, but you get to the point where, as you said, you don't know anything, but then you do have these understandings of the different reactions and how the market works in that regard. But yeah,
Exactly.
perfect. So Weston, thanks again. So if anyone wanted to find more of your work, you're on Twitter. Where else would people be able to find your stuff?
Yeah. So I mean, so I'm global markets editor at Real Vision. So just on Real Vision, I put out YouTube videos on behalf of Real Vision as well. But if you want the most kind of up to date stuff, either like market commentary or just general commentary of markets, just follow my Twitter. That's also where I'll probably most of the time post like new videos that I put out, and so just to stay on top of that. So that's just across the spread.
Yeah, perfect. I'll put that in the description below. So Weston, thanks again.
Thanks so much, Anthony. It's a pleasure talking to you, and great job with your podcast. I wish you all the best.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.